Hey guys, welcome back to the channel. It's me, Adam. You're watching Unlimited Options Investing. Desktop Metal got absolutely obliterated today, down 14.84%. It reached a 52-week low at one point, and if we look at the last year, ever since it was a SPAC, we are well off those all-time highs, down 78.14%. Now at $6.83 a share. They reported earnings on Monday after the close, after hours, and obviously investors weren't too pleased. So as you probably know, Desktop Metal is a company involved in 3D printing. Truth be told, we don't know where the bottom is on this one. So stock is expensive even with all of the revenue growth it has seen. It has, however, made tremendous moves to expand the business. While the company is exciting, the stock has been a flop since it came public through the SPAC process. At $6.90 a share, it is very speculative. Before discussing the company, we will get right to the chase. We think it is prudent to let this one form a base and consider buying in for a swing trade when momentum turns positive. It may be tomorrow, it may be next week, but here at $6.90, we think it is going lower before bouncing. Long-term investors are obviously way underwater here. We can see the case for new money coming in for a multi-year investment. We like what the company is doing, and this has been a transformative year, but we are neutral on this one today here. As traders, that may change tomorrow, even depending on price action, though likely it will be a few sessions before at least the momentum changes. For now, we think it is best to wait until the stock stabilizes more. So why even consider this long-term name? Before focusing on the trading side of things, we want to tell you why we like the company generally speaking. The stock, however, is another story. We like the company as it is pioneering so-called additive manufacturing 2.0. Boil it down to basics, they are really striving toward improving the efficiency of 3D printing with the idea of bringing it to scale. If it can be demonstrated as effective, reliable, and efficient, it is likely this approach will experience massive growth over the course of this decade. Another bullish development that has been known but just recently executed was that Desktop Metal finished the acquisition of X1 last week. The company has been expanding heavily. The bottom line here is that while the technology is incredibly impressive in a somewhat competitive landscape, the growth the company is displaying is largely powered by these acquisitions. And yet here we are at the new 52-week low. How come? Despite all of the moves and the massive year-over-year revenue growth, the performance has been far less than expected. The just reported quarter was a top and bottom line miss. That is simply not good enough for a company that was priced around 20 times forward sales. One positive thing about this big sell-off is that now the company is priced less than 2 times its book value, excluding X1, but even at $6.90, the stock is expensive. Because the stock is expensive, even in the single digits, the company had to deliver beats to get some mojo back. The misses on both lines were quite a shock. This comes despite revenue growing over 900% over the last year. The revenue of $25.4 million was a substantial $3.1 million miss versus the consensus. This is simply not good enough, folks. This is how the stock market works in its crazy ways, is that even when it has a 900% revenue growth, there's so many other factors that you have to consider that you may not initially when you look into a stock and when you're buying into it for the first time. There were some positives to be aware of, not just with the business developments and new customers on the fiscal end. Desktop Metal did register a 180 basis point sequential increase in its gross margins. That is a plus. However, net loss ballooned to $66.9 million, a much larger loss than $19.4 million last year. It was a large revenue miss. It was not a surprise the bottom line also missed, with EPS at a loss of 26 cents, missing consensus by a huge 14 cents. The guidance was also way below expectations, not including X1. Following this dismissal performance relative to expectations for the full year, the company issued guidance for revenues of $92 million to $102 million, well below the $105.2 million analyst consensus estimate, as well as adjusted EBITDA of negative $80 million to $90 million. The article continues going on. It's on the Seeking Alpha. So long story short, earnings weren't good, but taking a look at the technical analysis, so today we had that gap down and we actually sold off all the way down to about $6.45, which is a 52-week and all-time low for the stock. At the bottom of this channel, if it doesn't hold up, we could be going who knows how much lower. Is that the money that you put into the stock short term, be prepared for it to go down 10, 20, 50, 60, 70, 80%. It is a high risk, high reward play, but again, long term, if they get their execution in order, and I'm talking at the end of 2022, 2023 toward the middle of the decade into the end of the decade, there's a lot of potential for this stock to become a 5, 10, 15, 20, and who knows how big billion-dollar market cap. Whereas right now we are at $1.78 billion. However, the stock is way ahead of itself, especially given the earnings and the guidance we just got. So let me know in the comments below what you guys think of Desktop Metal stock. Are you trading it? Are you investing it for the long term? Comment below, and if you're new to the channel, welcome aboard and hit that subscribe button. As always, smash that like button, and I will see you in tomorrow's video.